Good evening, and welcome to tonight's financial and geopolitical coverage. The time is 11:47 Eastern on Thursday, March 5th, 2026, and silver is currently trading at $82.39 per ounce. While mainstream financial outlets have been reporting that the precious metals safe haven trade has lost momentum, a significant development has emerged from reporting by Axios and Bloomberg that analysts say warrants close examination. According to those reports, the United States government has finalized an emergency agreement to import 1,000 kilograms of physical gold from Venezuela. The transaction involves Manurvan, Venezuela's state-owned mining company, and is being facilitated through Trafigura, one of the world's largest commodity trading firms. The gold is described as doré bars, semi-refined gold containing impurities that require further processing before reaching final market-ready form. Those bars are reported to be in transit to American refineries, where they will be processed into what are known as London Good Delivery bars, the standard format used for storage in Federal Reserve vaults and international settlement purposes. The significance of this transaction, analysts note, lies in the legal and policy context surrounding it. The United States has maintained comprehensive sanctions on Venezuela since 2019. Those sanctions are designed to prohibit American entities from conducting financial or commercial transactions with Venezuelan state enterprises. Manurvan, as a state-owned company, falls within that framework. The use of Trafigura as an intermediary, under what reports describe as an emergency exemption clause that has not been made public, is the mechanism through which the transaction was structured. At current gold prices of approximately $2,700 per troy ounce, 1,000 kilograms, equivalent to 32,150 troy ounces, represents a transaction valued at approximately $86.8 million. Analysts tracking the transaction say the dollar value, while substantial, is secondary to what the nature of the deal reveals about official attitudes toward physical precious metal accumulation at the government level. To fully understand the significance of the Venezuela gold transaction, it is necessary to examine the sanction framework that surrounds it and the specific mechanics through which the deal was structured. United States sanctions on Venezuela, imposed in 2019, represent among the most comprehensive trade and financial restrictions the American government can apply to a foreign nation. Under that framework, American companies and government entities are formally prohibited from conducting commercial transactions with Venezuelan state enterprises. Manurvan, the state-owned mining company identified as the source of the gold in this transaction, falls squarely within that restricted category. The reported use of Trafigura as the intermediary is the structural element that analysts say requires the closest scrutiny. Trafigura is one of the largest commodity trading houses in the world, operating across oil, metals, and minerals markets on a global scale. Its role in this transaction, according to the Axios and Bloomberg reports, was to serve as the intermediary party through which the gold changed hands, receiving the doré bars from Venezuelan mining operations and facilitating their onward delivery to American refineries. The specific legal mechanism described in the reports is an emergency exemption clause, the terms of which have not been disclosed publicly. Analysts note that the existence of a non-public exemption clause within an otherwise active and comprehensive sanctions regime is itself a notable feature of the arrangement. The historical pattern of government behavior toward physical gold during periods of financial stress provides context that analysts say is directly relevant to the current transaction. In 1933, Executive Order 6102 required American citizens to surrender privately held gold to the Treasury at a price of $20.67 per ounce. Following that transfer, the government revalued gold to $35 per ounce in 1934. A 70% increase applied immediately after the transfer of ownership from private citizens to the federal government was complete. In 1971, the Federal Reserve and the Bank of England were engaged in coordinated gold sales onto the open market during the years preceding the closure of the gold window, an action analysts describe as designed to suppress the price and maintain the appearance of dollar stability. Following the closure of the gold window in August 1971, gold rose from $35 per ounce to over $800 by 1980. In 2008, central banks were publicly characterized as net sellers of gold and described the metal as having limited relevance to a modern investment portfolio. By 2010, those same central banks had reversed course and became net buyers, purchasing gold at $800, then at $1,200, then at $1,500, and continuing through to the current price range of approximately $2,700 per ounce. Analysts describing this recurring pattern characterize it in three phases. The first is a suppression phase, during which paper markets are used to hold prices below fundamental value. The second is an accumulation phase, during which institutional and government buyers acquire physical metal at suppressed prices. The third is a release phase, during which the price is allowed to move toward its market clearing level. The Venezuela gold transaction, analysts argue, is consistent with behavior characteristic of the accumulation phase. Specifically, a government securing physical metal through non-standard channels at a time when official statements emphasize the strength of paper assets and downplay the relevance of precious metals. The repo market provides additional context for understanding the urgency that analysts say underlies the current accumulation activity. The repo market is the overnight lending facility through which banks borrow cash using treasury bonds as collateral. It serves as the foundational plumbing of the modern financial system. In September 2019, the repo rate spiked to 10% overnight during what was described at the time as an economic expansion, a period of record low unemployment and record high equity valuations. The Federal Reserve was required to inject hundreds of billions of dollars in emergency liquidity to stabilize the system. Analysts note that the fragility exposed in 2019 has not been resolved. The Federal Reserve's balance sheet remains at approximately $7 trillion following attempts at quantitative tightening. The Treasury has issued an additional $2 trillion in new debt to fund the current fiscal year's deficit. Foreign central banks have become net sellers of United States Treasury bonds for the first time in decades, reducing the pool of available buyers for new government debt issuance. The collateral base underpinning the repo market has therefore weakened, not strengthened, since the 2019 episode. JP Morgan's settlement of nearly $1 billion in fines related to precious metals market manipulation over a 10-year period is cited by analysts as documented evidence that suppression of paper gold and silver prices is not theoretical. That settlement is described as public record and settled law. The fines imposed, analysts note, represented a fraction of the profits generated by the activity, providing a structural incentive for its continuation. The divergence between the paper price of silver and the price at which physical silver is available for purchase is a central feature of the current market environment that analysts say is widening on a daily basis. The spot price of $82.39 represents the price determined by futures contract activity on the COMEX exchange and through the London Bullion Market Association's unallocated account system. That price, analysts emphasize, is not the price at which a 1-ounce silver eagle or silver maple leaf can be purchased from a retail bullion dealer. Current retail premiums are reported at levels that place the effective physical purchase price of a 1-ounce silver coin at approximately $98 or higher, representing a premium of approximately $15 to $16 above the stated spot price. The structural reason for this divergence, analysts explain, lies in the nature of the COMEX as a fractional reserve system. The exchange issues paper claims to silver in volumes that substantially exceed the quantity of physical metal held in registered vaults and available for delivery. Estimates of the ratio of paper claims to deliverable physical silver range from 100 to 1 to higher. Under routine market conditions, the overwhelming majority of contract holders settle in cash without requesting physical delivery, and the leverage within the system does not become visible. When a sufficient number of contract holders simultaneously request physical delivery, the system faces a settlement stress event. Analysts point to the March 2020 episode, in which the spread between paper and physical gold widened sharply, and the United States Mint arranged emergency transport of gold bars from London to New York to maintain market function, as a documented example of that stress becoming visible. The 2021 retail silver purchasing event, during which approximately $1 billion of physical silver was purchased within a 2-week period, and premiums reached $15 above the spot price as dealer inventories were exhausted, is cited as a second example. The Shanghai Gold Exchange is identified by analysts as the venue where physical price discovery is currently most visible outside the Western paper markets. Unlike the COMEX, the Shanghai Gold Exchange operates as a physical delivery market in which contracts result in actual metal being transferred to a vault. Because the exchange reflects genuine supply and demand for physical metal in Asian markets, prices on the exchange consistently carry a premium over the London spot price. Gold in Shanghai is reported to trade at a $20 to $50 premium over the London Bullion Market Association spot price. Silver carries premiums at comparable or larger levels. Analysts describe this persistent premium as a direct reflection of physical demand in Asia exceeding available supply, and contrast it with the suppressed paper price in Western markets as evidence of the divergence between paper and physical pricing mechanisms. The industrial demand fundamentals for silver are cited by analysts as a structural factor compounding the supply pressure. Silver is identified as the most electrically conductive metal available and is used across a range of critical manufacturing applications. A standard smartphone contains approximately half a gram of silver. A laptop contains approximately 3 grams. A conventional internal combustion vehicle contains approximately 25 grams, while an electric vehicle contains over 30 grams due to silver's use in battery management systems, charging infrastructure, and power inverters. A solar panel contains approximately 20 grams of silver paste used to conduct electricity through the photovoltaic cells. The International Energy Agency has estimated that solar panel installations will triple by 2030, implying an increase in silver demand from the solar sector alone of approximately 200 million ounces annually. Combined demand from electric vehicles, fifth-generation telecommunications infrastructure, defense applications, and medical devices is projected to push total industrial silver demand above 1 billion ounces per year before the end of the decade. Against that demand trajectory, global silver mine production has remained essentially flat at approximately 800 million ounces annually for the past 10 years. Analysts describe the resulting structural deficit as one that is being temporarily masked by the drawdown of above-ground stockpiles, exchange-traded fund inventory liquidation, and recycling, all of which are finite sources. The geopolitical dimensions of the current precious metals accumulation environment extend beyond the Venezuela transaction. BRICS member nations, Brazil, Russia, India, China, and South Africa, have been publicly developing an alternative international trade settlement system designed to operate outside the US dollar framework. Russian and Chinese officials have stated at BRICS summits that the alternative system is intended to be backed by a basket of commodities with gold at the center. China's officially reported gold reserves stand at 2,264 tons, though analysts estimate the actual figure is considerably higher when purchases made through state-owned entities not reporting to the People's Bank of China are included. Russia has increased its gold reserves from approximately 500 tons in 2010 to over 2,300 tons. India has been purchasing gold from Russia using rupees, bypassing dollar settlement entirely. Brazil has been settling trade with China in yuan. The World Gold Council reported that central banks purchased over 1,000 tons of gold in 2024, the second highest annual total on record. Analysts note that the official figures likely understate actual purchases, as transactions conducted through non-reporting channels such as the Venezuela deal are not captured in publicly available data. The United States' own fiscal position provides the broader monetary backdrop against which these developments are occurring. Official national debt stands at $35 trillion, increasing by approximately $1 trillion every 100 days. Annual interest payments on that debt now exceed $1 trillion, surpassing the annual defense budget. The off-balance sheet liabilities represented by unfunded entitlement obligations, including Social Security and Medicare, are estimated at over $200 trillion in present value terms. Analysts describe the combination of on-balance sheet debt service requirements and off-balance sheet obligations as a fiscal trajectory that cannot be resolved through conventional means, and that historically has been addressed through currency debasement, the deliberate reduction of the currency's purchasing power to reduce the real value of outstanding obligations. The historical monetary record of silver provides additional context that analysts say is absent from mainstream financial coverage. Silver served as the primary currency of the Roman Empire, Chinese dynasties, the Spanish Empire, and the early United States. The Coinage Act of 1792 defined the United States dollar as 371.25 grains of pure silver, not a paper instrument, but a specific quantity of physical metal. Silver coinage continued in the United States until 1965, when the Coinage Act of that year replaced silver coins with copper-nickel-clad coins carrying no intrinsic metal value. Since that transition, the paper dollar has lost approximately 98% of its purchasing power. A single silver quarter from the pre-1965 era carries a current melt value of approximately $4.50, sufficient to purchase a gallon of gasoline at current prices. The paper equivalent of that quarter, 25 cents, cannot. Analysts cite this comparison as a concrete illustration of silver's historical capacity to preserve purchasing power across extended periods of currency debasement. The 1980 Hunt Brothers episode is referenced as a historical parallel with structural similarities to the current market environment. Beginning from a price of approximately $6 per ounce, the Hunt brothers accumulated hundreds of millions of ounces of physical silver and silver futures contracts, driving the price to $50 per ounce within less than a year. The COMEX response included the implementation of Silver Rule 7, which prohibited new long positions and permitted only liquidation orders, a mid-market rule change that analysts describe as having effectively dismantled the position. Silver fell from $50 to $10 within weeks of the rule change. Analysts note that the current accumulation of physical silver is occurring on a scale that includes sovereign nations and central banks, not solely private investors, and argue that the regulatory responses available in 1980 are not applicable to sovereign-level demand. The Chinese experience of the Coinage Act era is cited as evidence of silver's monetary role in non-Western economies. Silver functioned as the primary monetary metal across multiple Chinese dynasties and remained central to Chinese commerce through the 19th century. Analysts note that contemporary Chinese institutional and retail demand for physical silver is among the strongest globally, and that the Shanghai Gold Exchange's persistent premium over Western paper prices reflects that demand in real time. Returning to the immediate market conditions, the gap between the COMEX paper price of $82.39 and the physical retail price of approximately $98 per silver eagle is described by analysts as the most visible current manifestation of the divergence between paper and physical markets. Prior episodes of premium expansion include the March 2020 delivery disruption, when the spread reached approximately $8 per ounce, and the early 2023 banking crisis period, when premiums reached $12 above spot. The current premium of approximately $15 to $16 above spot represents the widest divergence in recent market history at a non-crisis moment, which analysts say reflects the ongoing physical demand pressure rather than a temporary event-driven spike. The Venezuela gold transaction sits within this broader context as a data point that analysts say reflects the behavior of a government acting on its assessment of precious metals' strategic value, an assessment that differs from the public statements being made simultaneously about the strength of dollar-denominated assets. 1,000 kilograms of gold, valued at approximately $86.8 million at current prices, moved from a comprehensively sanctioned nation through a commodity trading intermediary to American refineries under a non-public exemption clause. The transaction was reported by Axios and Bloomberg and is described as a leaked international commodities trade agreement. No official public statement regarding the transaction has been issued by the United States government. In summary, the developments reported on Thursday, March 5, 2026, center on a leaked report of a United States government agreement to import 1,000 kilograms of physical gold from Venezuela's state-owned mining company Manurvan, using Trafigura as the facilitating intermediary. The transaction is structured around a non-public emergency exemption to active United States sanctions on Venezuela. At current gold prices, the shipment is valued at approximately $86.8 million. Silver is currently trading at $82.39 on paper markets, while physical retail premiums place the effective purchase price of a 1-ounce silver coin at approximately $98. Analysts identify the transaction as consistent with a documented historical pattern of government and institutional precious metals accumulation during periods when public statements emphasize the primacy of paper assets. The structural fiscal conditions underlying this activity include $35 trillion in official national debt, annual interest payments exceeding the defense budget, and off-balance sheet entitlement liabilities estimated at over $200 trillion. Central bank gold purchases reached over 1,000 tons in 2024, the second highest annual total on record, with the majority attributed to China, Russia, India, and Turkey. We will continue to monitor these developments and bring you updates as further information becomes available. Thank you for watching, and stay with us for continuing coverage.